And good morning, everyone. John Hutchinson and Jeff Wood with Traders Reserve. Welcome to Breakfast Club this July 28th, 2025. I don't know about you, but I don't know where July went. Last time I checked, it was April. And here we are, and nearing the end of summer already. That's a little shocking. Jeff has a pretty deep slate of economic news and updates and more, so he'll be along in just a moment with that. I want to kick off with a couple of things on my side if we get the slides moving. First, last week we announced the Millionaires Trading Club live event, which is taking place in Las Vegas this October 21st through the 23rd. This is a 100% live trading experience. You can attend in person in Las Vegas at the Hyatt Place Silverton Village, or you can join us virtually, your choice. Tickets are on sale now, and we'll have emails out about that throughout the week. This week is pre-sale. You can save $200 on your ticket. We still have 30 some odd seats available in Las Vegas. And virtual seats aren't limited, but of course, any chance you get to save a couple $100 is always a good thing. So more details, you can also find our happy hour replay on the dashboard here on the Traders Reserve Live website. But again, we'll email you our big plans for this year's event, including the mystery cash slot machine challenge, our live trading plans, and more throughout the week this week. So look forward to seeing you there. One of the things to look forward to as part of the Millionaires Trading Club event and future Breakfast Club weekly income reports is I started building these charts to track a combination of capital in play and performance. This is the chart that I used during happy hour last week, which showed the capital and the profit from or during the live event last year from the trades that we made during the live event, running out about 3-4 weeks post event, as we had some trades that closed in early to mid-November. But what this shows you is sort of a rolling mechanism to visually see how you're using capital and how that capital is performing over time. Our event last year had some pretty big wins right out of the gate, a number of trades closing while we were in Las Vegas. Not dissimilar to the experience folks are having right now inside of the Millionaires Trading Club program. But for our purposes last year, really the most of the capital was in play by the second day, and then every day after that was just largely taking trades off the table, booking profits. We had some losses in there, but by the end of it, if you were trading at scale, which is it was anywhere from 1 to 5 contracts per trade, had over $9,000 in total income booked within 30 days of the event. If you were just trading one contract per trade, it was over $5,800. So whether you're trading big or small, there's something for everyone at the Millionaires Trading Club live event and inside the Millionaires Trading Club program. We'll take a look at that here in just a minute. A quick segue into the weekly income report. I'm not going to be covering income masters this week for a couple of reasons. So here those reasons are. I'm working on a new format, in part because we have not had a good mechanism for tracking many of our longer term positions. And I want to find a way to build that in because it gives you both context and a wider view of what's happening inside of the program across all of the positions, not just the short-term trades, but short-term trades, income madness, and perpetual income trades. I'm also going to begin a deep dive on some of the stocks that we've been trading longer term for context purposes. So I've been building anywhere from a this year to 5-year record of some of those stocks, and to give you a different way to look at the way that the way that Dave is approaching or trading some of the positions inside of Income Masters. Also building in the equity curve and capital efficiency charts, just as I showed you, and I'll be adding those to both Income Masters and Millionaires Trading Club in the weeks ahead. I do want to take a quick couple of minutes and cover Millionaires Trading Club. Another busy, crazy week. 10 trades closed on the week. Average time in trade was 4 days. Total capital across those 10 trades, $27,011. But note that much of that is and I'll show you this with the Russell in just a second. Trades put on Monday, close Tuesday, new trade put on Wednesday, close Thursday, like that. So keep in mind, that's where these charts can become helpful in looking at the way that the capital efficiency, right? Capital in, capital out, because some of these trades were very short lived. I think the longest trade there to date for new trades that we've put on in July is 14 days so far. That'll change. Eventually, we'll have a trade that runs longer. But for most of the trades for all of the trades, or across all of the trades that we have put on in the new format, we're averaging 3.2 days time in trade. So that's pretty short. That's actually leading to some frustration for Dave. He's finding it hard to maximize capital, as is Jeff, because they're in and out of trades almost too fast. But that's not a bad thing. Keep in mind, with the markets that we have, I know markets are at highs, likely to move higher given trade announcements over the weekend. Um, they there are still risks to the markets at all-time highs. And I think I still think that most people don't feel like the market is at an all-time high. That's typical when you have a significant down sell off like we did in April, nearly 20%, right? It doesn't feel like like we're at that at new highs. So the key here is the capital that is being put in use is winning consistently. We're on a win streak, which I'll probably jinx right now, but we've won 24 trades in a row in the Millionaires Trading Club that were put on in July. We had a couple of trades that dated back to May that were closed as losses, but for the new trades that we put on in July, we've had 24 wins this month. And an average return per trade of just over 12%. For the last week, we closed over $2,400 in profits, or for an 8.9% return on capital. So it was big week, busy week. As Jeff will talk about, this is big data week. Number one, there are usually two big data weeks per month. This is the second big data week. So if we're going to see any change in momentum in the market, it's going to be this week. It'll likely happen this week. And so going back to one of our top trades for the month in July in the Millionaires Trading Club, the Russell 2000, the RUT. We've traded it with both a bear call and bull put spreads 8 times in the month so far. All wins. You can see the profits ranging from a low of $230 to a high of $432. This is trading an average of 5 contracts per trade. I think we traded 4 contracts on one trade. All of the rest have been 5 contracts per trade. So over $2,500, or nearly 50% of our gains for the month, have come from this one ticker, trading it consistently. And several of these trades you can see starting around the 14th of July have been very quick trades, 1-day trades, an accidental 0-day trade, and then almost 2 days per trade right now. So we're getting our profits hit quickly. So we're able to take money off the table, hop back in with new positions, and repeat that process. So far, so good. So for the month to date for July, $5,370, big month for Millionaires Trading Club members. Overall for the year now, up over $11,700. So that's more than doubled or nearly doubled our total gain for the year. We have another good week. We will be beyond doubling that in the space of just 1 month. So good things happening in Millionaires Trading Club and Income Masters, but I'm really excited about Millionaires Trading Club, in part because this is what we had expected and wanted to see by combining the other programs into a single program. So we have better focus. We have more than enough trade and trade volume to generate consistent income. Dave is more than doing better than his expected weekly target, $1,500 a week. So he's outpacing that right now. trades being put on or taken off quickly enough to generate consistent gains. So Dave and Jeff doing a great job inside of the new Millionaires Trading Club. Hope you're trading with us in that program. If you're not, buy a ticket to our live event in October. See what we're doing. Most of the trades are relatively simple tactics, nothing complicated or complex, but certainly to date, profitable. So with that, Jeff, are you ready to go? I know you have a lot to share. Jeff, did you go somewhere?
No, I was just trying to find Zoom and the inevitable trying to find the unmute button. But anyway, thank you. Yeah, thank you, John. Thank you, everybody. Nice to see everybody this morning. So let's just get to it. Just trying to. The other fun thing, as you probably heard from Dave or me, as we do these things, is getting Zoom and PowerPoint to work together. Always a good time. So, all right, let's do this. Hopefully everyone can see. All right.
Yep.
So what is ahead for the week? Well, futures up overnight. We'll take a look at the futures chart. I want to do a little bit less PowerPoint stuff today, more on the charts today, but futures up overnight due to a trade deal between the United States and Europe. The baseline tariff is now settling down at 15%, down from the proposed 30%. There was some time where both countries, or well, the European Union, and the U.S. Didn't seem like they were going to get a trade deal done before August 1st. There was threats of retaliation, tariffs, all the rest. At one point, tariffs were up to 30%, and then with threats going even higher. So the nice thing is they've settled at 15%. Seems to have an agreement in place. So the good news is down from that 30%, down from higher than 30%. It's certainly higher than the previous 1.2%, though. So we'll see how that goes. Europe is going to buy 750 billion with a B worth of energy products. Europe is also going to invest 600 billion, again with a B, in various US projects. And then Europe is also going to buy military equipment. And if you remember, we talked about companies like Northrop Grumman, Lockheed Martin, some of those with that big, beautiful bill. Well, now Europe is set to buy more military equipment from the US. So some of those companies, in addition to the big, beautiful bill, could see their stock price rise. We have earnings from major tech this week. We have the Fed interest rate decision. We have economic data, including jobs report, Fed inflation gauge, and the estimate for the second quarter GDP. But what I want to talk about just for a quick second is the fear of missing out. I think John talked about this a little bit in the happy hour session too. But overall, what is helping to drive the market higher right now, we have earnings that are mostly positive. And if you recall, we talked about this in MTC, if you're part of MTC, or Dave mentioned this, but a lot of the companies lowered their guidance last quarter. There were so many unknowns around tariffs. Remember that we had an initial tariff deadline of July, then it got moved back to August. And so way back when tariffs were announced, everyone just said, hey, I don't know what's going on, don't know what everything will settle in. So all these companies, CFOs, CEOs, all lowered guidance. And then lo and behold, now we're beating. Now all these companies are coming out saying, oh yeah, we're beating. The consumer is still buying stuff, even if prices are ticking higher. Everyone, I was just hanging out with some friends Friday night, and everyone complained about how everything is higher, and yet here we are, going out and still having a good time. So, we're all complaining about prices being higher, but we're all spending, and that's not really changing anything. So it's not bringing prices down. Why would anyone lower prices if people continue to spend? So, and that's sort of that economic data is not really falling apart line. We're not seeing major, we'll talk about jobs in a second, but we're not seeing, mass layoffs. It certainly feels like it in some industries, but we're not seeing that, across the board. Retail spending is still good, all that sort of stuff. I mean, Amazon.
So
the,
Can I interject for just a second? Two things
yeah,
that we want to keep an eye on. One is in several of the earnings reports to date, companies have been clear that they have not yet passed costs on to the consumer.
yes, no,
Uh,
yeah, yep, yep,
and one of the things to keep your eye on next week is first the first court case challenging Trump's authority to invoke tariffs goes before the federal appeals court. The question that we need to ask is whether or not businesses are eating the tariffs in the short term with a potential expectation that the administration will lose those court cases all the way up to the Supreme Court. Piper Jaffray, which is a big Wall Street firm and research firm, put out a note to their investors, essentially saying that they expect that the administration will continue to lose in the lower courts, and that the Supreme Court will eventually overturn those tariffs. So that's part one of this. And part two of this on the consumer side is to remember two things. Number one, it's summer, and nobody wants to scuttle their plans for summer. So that which dovetails into number two, which is consumer behavior is always slow to change. So if companies are not yet passing those costs on to consumers and across the board, then consumers are not seeing all of those tariff costs yet. GM, what did GM report that they lost $1 billion due to
right,
tariffs?
right.
There's no way GM can eat that over 4 quarters, right? That would be $4 billion a year. And so my suspicion earlier on was that we would not necessarily see tariffs it reflected throughout the entirety of the economy right away. That there might be some wait and see, because I'd have to go through a list of like 60,000 products to figure out exactly what's tariffed and what isn't. And I'm not doing that. So I
Oh,
think
come
there's still
on.
some, okay, maybe I'll go through five. How's that? But I still think that is the underlying, that is one reason why earnings have been fine. They've been just fine for the first 10 days here. Big tech is less of a concern as it relates to tariffs unless you're talking about chip companies. But you have Amazon and Apple, Microsoft, Meta, all of those are reporting this week. So there is any beats across the board by those four companies going to drive tech higher, especially on the AI side of the house. The AI, I think, is still artificial intelligence, still propping up this market. There's no tariff there. So the question really then becomes: are we talking about like the new economy in terms of artificial intelligence leading this market higher, and leading, in a sense, the economy higher, versus the old economy, which could be anything from manufacturing to older chip stocks, trailing and not being able to keep up. We're in a really weird place in that sense, and I don't think tariffs are the thing, but we have not seen them be a thing as of yet. I don't know that we get any more clarity on that this week. Certainly not this week, but in the quarters ahead, that between that and whether or not those tariffs stay legal isn't really the right term, but legal is the term I'll use for right now. Whether or not the Supreme Court does not stop those tariffs from being enforced by the administration.
Yeah. Yeah. So I think what John, I agree on all this. What I was going to say is this is what is helping drive the market higher, but I would be a little bit, or I am still a little bit cautious in the quarters ahead, because I don't think that we've really seen the entire tariff story play out. We don't really know when that will happen. There are certainly economic indicators that we will look at to see when, if any cracks form. But for right now, what we're seeing is the economic data isn't really falling apart. We are seeing some clarity with lower than expected news on tariffs, and
Oh, do
then
we have a trade deal with the Penguins yet?
yeah, I haven't seen anything with like Madagascar or yeah, I think those were all sent notes, and they're just going to end up being stuck at that baseline. But so you have the market up, way over 20% since April. So that's getting attention. So I think you see all of these people now rushing into the market, especially retail traders who were on the sidelines saying, hey, look at that. I told you so. Tariffs, not so bad. So now they're throwing their money in. So that's what's helping drive the market. We'll see how long that happens. As we've been talking about for many weeks now, seasonality starts to slow down in August after after major tech earnings, which are coming out the end of this week. So whether we hit seasonality and start falling off a little bit, a lot, or not at all, we don't know. I mean, just seasonality is just letting you know what has happened in the past. But we do see some of that euphoria after July earnings start tapering off, and then maybe people actually do go on vacation for August. So we'll see how that plays out. As far as the economic calendar goes, just a list of a lot of things. So especially if you're into those zero DTE trades, you definitely want to be a little bit more cautious this week, or certainly around some of those times. Wednesday, we have a lot of things coming out pre-market, but you do have the Fed meeting at 2 o'clock. So Wednesday may be a day that you either want to get out before 2 o'clock or just not trade at all on FOMC days. But we do have JOLTS job openings, which I'm going to show in just a second. We have ADP non-farm employment change. So interesting is the JOLTS job openings going down from the previous report from 7.7 million to 7.4 or 7.5 million. Yet the non-farm payroll employment change is actually moving higher. So people have positively changed jobs, if you will, but less jobs are open than previous time. We do have, again, mentioned this about advanced GDP quarter over quarter, expecting to be higher than the previous report, which again would be good. If there's any sort of surprise, I mean, right now, I think there's 98% chance that the Fed keeps rates the same. Certainly that is, I think you're starting to see the Fed governors sort of separate a little bit more, as there's drama around the president wanting to fire Powell and then naming one of the other Fed governors, or potentially naming one of the other Fed governors. And so now you start seeing some drama within the Fed, which is not really what we want to see. We do have a PCE price index coming up with a estimated slight tick higher than the previous time. So anyway, a lot of economic news. Just wanted to go over this really quick. The jobs opening I mentioned is ticking lower from 7.7 million to 7.5 million. So the question is when we're supposed to see all these manufacturing jobs come into play. We're supposed to see the economy getting better. We're supposed to see tariffs not really affect, or tariffs are supposed to be affecting the economy in a good way. The big beautiful bill is supposed to be affecting the economy in a good way. So so one of the things that that we'll be watching is the job openings. You'd think that when all of that takes place, of course, let's be positive about all this. When that all takes place, we'll start seeing an uptick in job openings. And now the one on the non-farm pay employment change, last time we actually had a negative number, and that you can see we haven't had a negative number in years. So if we do get this 82,000 to the positive side, that actually dates back to around April of this year, and that was right when the market started taking off. It was April 7th. So we'll see. There's some positive news coming out that could certainly help drive the markets higher. We just have to be a little bit careful, as John likes to talk about. I mean, S&P 500 valuations are incredibly high, and historically, when they are this high, it doesn't always do well 12 months from now. But we're going to take a look at some charts and get into more detail in just a second. We're already at 30 minutes, so I'll go through this pretty quickly. the sector rotation, this is the chart last week. We said, hey, healthcare looks a little bit underdone, and utilities look a little overdone. So I was looking for a positive move in healthcare and maybe a little bit bearish in utilities last week when we met. Over the last 5 days, look at this, every single sector up for the previous 5 days. Healthcare, big winner, 3.41%. Utilities, I'm not always right. Utilities were actually positive as well. They weren't even the lowest of the positive one. Consumer staples, essentially flat. So, is tracking the tracking sector rotation 100% science? No. But utilities, if we see utilities last week were at 94%, utilities are at 90% of stocks trading above their 20-day moving average. So what that does say is, yes, utilities had a few stocks that were continuing to drive the entire sector higher, but that sector underneath is getting a little bit weaker with stocks coming below their 20-day moving average. So I still think utilities are a little overdone right now. I think there's still some strength in real estate, industrials, financials. I think consumer discretionary, it's a little bit of a yellow flag. We're at that 80%. We've certainly seen consumer discretionary and others get as high as 90% of stocks trading above their 20-day moving average. But 80% is also, sort of that yellow flag turnaround time. And so with the overall S&P 500 index at 69% of stocks trading above 20-day moving average, I do think that there's some room to go on the sector. The other thing I wanted to point out is this is an ETF that I track quite often, and this is the USA Equal Weighted ETF. And so John and I started looking at this, I don't know, geez, a year or maybe more ago. And what this, to me, we had a period of consolidation. We had a breakout of consolidation. Now, if we can come and retest this line and act as a line of support now, that would be a good indication of bullish behavior. So yes, that would mean that the EUSA would have to come down a little bit to come back and retest this previous resistance line and act as support. But what this is telling me is that over really since April, the entire US market equal weighted, all stocks equal. We're now getting a little bit more broad-based support in the rally. And certainly if you look at this from 1, 2, 3, 4, 5 days ago, we're prices at 100, we're now at 102. So it would take a good, 2.26% move in the EUSA for us to be trading lower than we were a week ago. So that's also a pretty good, green light. We have economic news, and I would definitely be very cautious with some of the trading based on just economic news, because you never know how everyone will react. But if the economic news wasn't there this week, just based on where we are on the EUSA, I would say that that's a green light to at least find good, strong, bullish candidates to move forward. With that, I know we're over time, but I'm gonna look at some charts really quick. So just give me a second, and we'll look at some interesting things. If I can find. Okay. Let's wait for that to hit the screen. Okay, so just really quick, wanted to draw your attention to futures. Futures looking to a positive open in about 30 or so minutes, with all S&P 500, NASDAQ, and Dow looking to be positive. So I'm going to hide that window for a second. What I wanted to show is, let's go to a weekly, no, not a weekly. Let's zoom out. Wow, what just happened? All right, so this is the start of 2024, and this is kind of where we are right now. And I know there's a lot on the screen, but what I want to show you is the specific numbers aren't that much of a deal. But the S&P 500 typically goes up, what, 10% over the last couple of years. It's actually been about 15% higher. So if you get rid of this whole mess that we had, if we didn't have the whole tariffs and everything else, a lot of people said, hey, getting out of 2022 was kind of a mess. 2023, 2024 seemed good. You know, there were some people projecting a 10 to 15% move higher in 2025. So if you look at this, just kind of drawing, oh, come on, what is going on? Think or swim. I reset you. Okay, so if you look at, you know, what would a 10% move, you know, if we didn't have this whole S&P 500, if we didn't have this whole, you know, tariff mess, what would have a 10% move higher this year gotten us to? Well, it would have gotten us to 6,400. Many big banks were projecting 6,400 prior to the start of the year. And it looks like, hey, look at that, we're at 6,395. So we could go lower, bounce around, you know, somewhere at 6,400. If we, you know, this is the end of the year. So if we ended up at a 15% gain, which is what other banks were projecting for the year, and that sort of matches what we've had. I think the average, you know, not taking out 2022, the average has kind of been a little higher than that 8%. You know, that puts us up at 67.25, and that would be, so you can see this number here, 15%. So let's get rid of that, just make things a little bit more clear to see. So we're certainly, you know, 67.26 matches a Fibonacci number, 64.27 matches a Fibonacci number. We're at 63.95. So the rally can certainly continue. There's certainly room to go. But what we haven't seen really since June is we haven't seen a significant pullback. We did a pause for duration over direction back in July, but we haven't really seen another, you know, 1 to 3% pullback. So we just need to be a little bit cautious about that, especially going into August. Then the other thing I wanted to show you is just futures. Oops, come on. Futures on the 5-minute. Whoa, what is going on? Trying to do too much. Okay, so we had a spike, obviously last night with the news of the tariffs being settled with Europe, and then we had a major move down. Started about 2 in the morning. So we'll see how the market opens up. The nice thing is if you just take a trend line and draw it across the tops, we did break that around 8 o'clock. We have been moving higher since 8. Let me get this all situated so everyone can see it. So we did break that trend line right around 8 o'clock. So we are starting to move a little bit higher. I would look, now that we've crossed this this tan line, I would look for a comeback at least to that 64.45-ish level on the ES futures. Remember, the futures and the S&P and the SPX don't always align one for one. So 64.45 intraday on the futures is what I would like to see it march up to. But you know, we'll see what happens at the open. But that's a pretty it's not a sell-off. I mean, it is a sell-off, but you know, remember we closed
Reversal.
Yeah, it's a reverse. I mean, we closed way down here. So really all we're saying is, you know, we're just not getting quite as high as what we were overnight, but we're still looking like we're pointing higher for the day. And I know we've already been going over, so I could sit there and show a bazillion charts, but I guess I'll just save those for Wednesday or for MTC or whatever. So
Okay, sounds good. What else do you have? Anything else, or is that it?
No, I think that's going to be it. I was looking for some free trade ideas, but I don't like any of the setups that I have for free trade ideas. So
Not trading is still a good form of trading.
yeah, yep.
All right. Well, we have Income Masters at 12:30, Millionaires Trading Club at 11 a.m. today. So we will see all of you in one or both of those sessions for the day. And Jeff and I will be back on Wednesday morning at 8:30 a.m. Hopefully we'll have a little more clarity in the market, even though that that'll be Fed day. So may not have enough clarity, but hopefully we'll be able to give you folks some trade ideas or other things you can keep track of for the days ahead. So we'll be back Wednesday morning at 8:30. And thanks for joining us today. For Jeff and for myself and everyone at Traders Observe, hope you have a great trading week, and we'll see you soon.